Okay, so let's discuss how the interest rate adjustment process actually takes place. And for that discussion, what we're going to do is make some simplifying assumptions. You guys have probably noticed along the way that that's what we do a lot in economics is we make simplifying assumptions. So the assumptions that we're going to make for the interest rate adjustment process is that people hold their wealth in one of two forms. Now, in the real world, I know there's lots of different ways that people can hold their wealth, but for the process of determining how the interest rate is set, what we're going to do is assume that banks, anybody in the money markets, hold their wealth in either money or bonds. So money is what we use to pay for our day-to-day transactions. You know, when you go to the store and you buy something, if you have a bond and you try to use it to pay for it, that's going to be complicated. However, if you have money in your account and you swipe a card, that's easy, right? The problem with money is that money doesn't make money. Money in and of itself, sitting in your wallet in the form of cash, or these days in a bank account, really doesn't make that much money on its own. So if you have too much of your wealth in money, then you're missing out on the opportunity to make money on your money. That's where bonds come in. If you have some of your wealth invested in bonds, the downside, of course, is that you can't use those bonds to pay for day-to-day transactions. But the plus side is that you're going to make a little money on your bonds. So the goal or your goal is to figure out how much of your financial wealth do you want to hold in money, how much of your financial wealth do you want to hold in bonds. So we discussed this earlier. I think it was in lecture 14, I believe it was, when we talked about how a coupon bond works. And I mentioned we have this formula that's supposed to determine the value of the bond. And the formula is BV is bond value is equal to the coupon payment divided by the interest rate, keeping in mind that the coupon payment is a contractual obligation on the part of the lender. In other words, when you bought this bond, you were lending money to somebody. It could be a company, it could be a municipality, and they're promising you to pay you on certain days a coupon payment. And if they don't do that, that could set off a whole bunch of transactions, a whole bunch of legal events. So if we take the coupon payment and we divide it by the interest rate, we should have the bond value. So now what we're going to do is we're going to look at how changes in the bond market affect the interest rate in the money market. So here's what you have to imagine. You have to imagine that there are two different markets. One is the money market, and the other one is the bond market. And you have to imagine that they're equalizing each other out because people are trying to figure out how much of their financial wealth they want to hold in money and how much of their financial wealth they want to hold in bonds. So try to imagine that maybe the interest rate is over here in the money market at R high, and let's say that could be because maybe the supply of money was once lower. But for whatever reason now, the supply of money and equilibrium in the money market would be over here at R sub E. Well, how do we go from R high to R sub E? There's actually a process. I mean, we just say, oh, we slide down the demand curve for money. Well, that's somewhat true, but here's what's happening. When interest rates are higher than the equilibrium interest rate, this creates a surplus of money, right? The difference between the quantity supplied of money and the quantity demanded of money is a surplus. That surplus of money is going to flow into the bond market. In other words, now that there's all this extra money sloshing around, it's going to be looking for a rate of return, and that's going to increase the demand for bonds. So if the demand for bonds goes up, then the price of bonds goes up. And because we have that relationship between the coupon payment and the interest rate, if the coupon payment is staying the same, but this time the value of the bond is going up, then that's going to push down the interest rate. It's going to do so because the price of bonds goes up, and that pushes down the interest rate in the money market. So it's the bond market that's adjusting for it's changes in the bond market that are adjusting the interest rate in the money market. All right, let's say we had just the opposite. So in other words, let's imagine that we start off over here at R low and Q high is at quantity. We're over here on the money demand curve, and it looks like equilibrium between the supply of money and the demand for money should occur over here at E, and the interest rate that would get us there would be R sub E. So what's happening as a result of this? Well, now we have a shortage of money. In other words, we have a surplus of bonds. We have too much in the way of bonds and too little in the way of money. So what's going to happen in a case like that is the demand for there's going to be a decrease in the demand for bonds. This is happening in the bond market. So the demand for bonds is shifting to the left. That's forcing the price of bonds to go down. And because bonds are cheaper, then people will not be as happy with bonds as they were before. If you're a bondholder, you might not be enticed, or a potential bondholder, you might not be enticed to hold more bonds if their value is going down. So money would flow out of bonds and into the money market, and that would lead to an increase in the interest rate. Does that make sense? So it's changes in the bond market that adjust the interest rate in the money market. So we talked about the way a coupon bond works, and we talked about how, if there's no change in the interest rate and we have the great algorithm in the sky perfectly pricing bonds, then the only thing that the bond market would be looking at would be what is a coupon payment, what is a current interest rate, and how much should I pay for a bond that gives a certain coupon payment over a certain amount of time. So there would be no change in the value of the bond if you needed to liquidate the bond early as a result of there not being a change in the interest rate. And then we also talked about what happens to the value of bonds when the interest rate rises, because now if you're a holder of a bond that is paying a lower coupon payment compared to a newly issued bond that is reflecting the interest payment that has to be paid at a higher interest rate, your bonds don't look so hot, so the value of the bonds are going to go down, and as the interest rate continues to rise, the value of your bonds also continue to fall. So that's what we're saying here now in this example, going back to where we were looking at this, is the changes that are taking place in the bond market are taking place because money is either flowing into bonds like we see over here, or money is flowing out of bonds, as we see in this case. So this is kind of the flip side of this coin. And then we also talked about what happens to the value of bonds when the interest rate falls. So if the interest rate is falling, then the value of previously issued bonds would go up because they tend to have a higher coupon payment. Does that make sense? So I'm just kind of giving you a refresher on this because bonds will be featured on the fourth exam. All right, now let's talk a little bit about changes in the money supply in the short run versus the long run. So in the short run, it's possible that increases in the money supply could lead to an increase in consumption, an increase in investment, because businesses see that they have more money, and if you see that the amount of money you have has increased, maybe you'll spend more. If you're a business and you see more business activity, which leads to more money, then you might invest a portion of that. However, let's assume that in the long run, and this is somewhat true, the quantity of goods and services, it doesn't go up just because the supply of money goes up. In other words, the quantity of goods and services is dependent on how much we can produce. How much we can produce doesn't really have anything to do with how much money is out there. So an increase in the short run, on the expenditure side of the economy, we could get an increase in consumption and investment. But if on the production side of the economy we're not getting an increase in goods and services, then the only thing that's going to happen as a result of this increase in money supply is that we'll see an increase in the price of goods and services. So that's why a lot of economists believe that the supply of money does not affect a real variable, like real GDP and how much we're actually producing. So this brings us to a thing called the quantity theory of money. The quantity theory of money is something that the Monitor School of Economics believes in. These relationships, though, I have to tell you, are not as strong for whatever reason as they used to be, but they're based on this thing called the equation of exchange. So the equation of exchange takes two forms. One is MV, and I'll explain what M and V and P and Q and P and Y. Well, I'll explain all that in a moment. One form is NV equals PQ, and the other form is MV equals PY. All right, so what is MV, PQ, PY? M is the stock of money. It's the amount of money that is circulating in the economy. V is a thing we call the velocity of money. The velocity of money you could think of as the number of times, let's say, a $1 bill changes hands over some period of time. It could be a month or a year. So obviously, if there's more transactions taking place, the velocity of money would be faster. If there are fewer transactions taking place, the velocity of money would be slower. P is the price level. In both these equations, M, V, and P are the same. The only thing that's going to be different is Q and Y. So what is the difference between Y and Q? Y is an index of expenditure on any type of product, new or used. The reason this is important is because if we multiply P times Q, we get real GDP. However, people are not limited to spending only on new products and services. They could wind up spending some of that money on used products. They could wind up buying a used car. They could wind up buying a house that already exists, and not a new house. The reason this is important is because of the way the quantity, the way we estimate, for instance, the velocity of money. That's the one thing that we don't know. So let's imagine that we have a situation like this. We have different quantities of money. Let's also further imagine that the velocity of money stays constant. That's why I'm calling it this thing called V bar over here. Let's also imagine that the quantity, the physical quantity of goods and services being produced also stays the same. And let's also imagine that the velocity of money, the equation of exchange holds. So here's the thing. So if we get a doubling of the money supply, so if the money supply goes from 500 to 1,000, and we get no increase in the quantity of goods and services that are being produced, and the velocity of money also stays the same, then what's got to adjust in order to bring both sides of the equation into balance? It's going to be the price level. So P would go from, let's say, 2 to 4 as a result of the doubling of the money supply, because we're not producing any more in the way of goods and services, and the velocity of money hasn't changed. All right, let's imagine now that we get another 500 unit in the money increase in the money supply. So the money supply goes from 1,000 to 1,500. Again, imagine that we're not producing any more in the way of goods and services. So the quantity, the physical quantity of goods and services is staying the same. And we're also going to imagine that the velocity of money doesn't change. It also stays strictly the same. Well, if we have a 50% increase in the money supply, that's what we get when we go from 1,000 to 1,500. Then the thing that's going to adjust on the other side of the equation to bring it into balance is we're going to get a 50% increase in the price level. P is going to go up by 50%. So that's what we'd expect to see. Now, again, the reason that we have two different equations, one being MV equals PQ, the other being MV equals PY, is because we don't know what the velocity of money is. We know what the supply of money is. We can see what the price level is. We can see how much we're producing in the way of goods and services, but we don't know the velocity. So we need MV equals PY to figure out what the velocity of money is going to be. And then once we have the velocity of money, we can apply that to the other equation, which is MV equals PQ. Does that make sense? Now, this is a time series graph showing the velocity of money over time, going all the way back to 1959. The thing that I find really interesting about this graph is that the velocity of money has stayed relatively constant for a long period of time. And then beginning in the 1990s, it shot up. It more than doubled its previous range. It came down a little bit in the early 90s, and then it went back up again, and then it took a real big drop during the Great Recession. Now, I haven't updated this. This only goes up to 2014, but there isn't anything that I know of that would suggest the velocity of money has somehow gone up to where it maybe was before this big drop. So one of the reasons why there's been this big, massive increase in the money supply and we haven't seen inflation is because the velocity of money has fallen. That's not the only reason. I think I showed you that other graph of the monetary base, and I explained that some of that money that was a lot of that money that was being created going to the banks was going into reserves. But another part that's equally as important is this big drop in the velocity of money. All right, so this brings us to the Monitor School of Economic Thought. I think I'll end it here, and we will discuss the Monitor's thought in the third and last part of this lecture. Boy, this is so much fun. What are you guys going to do after Econ is over? I mean, you might have to listen to this lecture over and over again to get the kind of fun that you've been having all semester long.